Hello everyone, welcome back to Mindful Investing. We are officially 7 months into 2025 and my portfolio just crossed a $33,000 gain. That's a solid 16% return year to date. Now, just to put that in perspective, the S&P 500 is up around 6% and Nasdaq about 7%. So yes, we are outperforming the major indices by more than 2x. But here's the best part. I've done this while keeping nearly 50% of my portfolio in cash. That's right. Half my portfolio have been sitting on the sidelines and we still crushed the market. And today's video, I'll walk you through exactly how I did it, the stocks that led me the charge, what I'm watching for August, and how I'm planning to deploy my cash in the coming months ahead. So stick around. You're about to see a strategy that's beating Wall Street at its own game. Before we dive into the core portfolio and long-term holdings, let me first walk you through the latest updates, the stocks I recently added, and a few that I've exited. These moves reflect both tactical swing trades and longer term positions. Let's start with what I've added first. The first one in the list is FICO. I bought around $1,800 worth of FICO. This stock has dropped over 31% in the last 3 months, mostly due to increased scrutiny around its monopoly in the credit scoring space. But my model still shows 26% upside in 1 year and a 215% gain over 5 years. The stock is approaching a key technical level, the 200-day EMA on the weekly chart around $1,250. That's where I plan to average down. Fundamentally, FICO continues to grow revenue and I don't think the impact from the regulatory fears will be as bad as the market thinks. Moving on to the second stock that I've added into my portfolio is Revolve Group. I bought 50 shares at $20.50 and the reason is simple. I called this out in my recent 11 undervalued stocks to buy now. Revolve has a strong balance sheet, tons of cash, minimal debt and positive free cash flow. I think the market's ignoring its long-term potential. If the stock pulls back to $15, I'll likely add more. Next up is McDonald's. I picked up 5 shares at $290 purely as a technical bounce play. The stock was oversold on the daily RSI and it's already showing signs of recovery. I've traded McDonald's a few times this year already, making 10 to 15% profits on each round. So this is a tactical swing trade for me. My current target is $310. The fourth stock I've added is ASML. I finally started my position in ASML, a stock we have also covered in the prediction series. I grabbed 2 shares at $700 and I plan to buy more at $650 and $600 if we get to those levels. ASML is the only maker of EUV lithography machines used for advanced chip production. This is a no-brainer for long-term growth. And the fifth one is Duolingo. I now have 11 shares at $366. Technically, this looks like a setup for a reversal. It is below its 200-day EMA on the daily chart and below the 50-day EMA on the weekly chart. They are reporting earnings next week, and while that adds volatility, I'm prepared. If it drops to $277, I'll be buying more. And the sixth stock I bought is Berkshire Hathaway. I bought 5 shares at $476, and let me tell you, this doesn't happen often. Berkshire is trading below its 200-day EMA, which is extremely rare. For a stock like Berkshire, where capital preservation and long-term compounding are key, I think this is a solid entry. This looks like a textbook long-term buy and hold setup, and I plan to keep adding if it dips further. Now, here's what I sold recently. First, I exited Johnson & Johnson at $166. They had fantastic earnings and the stock popped up over 10%. But from here, I expect sideways movement. So I decided to take profits and reallocate that capital. I also closed my position in CSX. Nothing major here, just a small profit. I didn't see compelling upside from here. So I booked gains and moved on. I also sold some of my placeholder buys. I sold off my 1 share of Meta after earnings at $781 and also exited Palantir, TSM and HIMS. All were up significantly after the April lows. I still like these companies long term, but I just don't feel comfortable buying more at these levels. I'm taking profits and moving on for now. I still hold Uber and Shopify as my placeholder buys. I like their upside potential even at current levels. And that's exactly why I sold a $78 cash secured put on Uber expiring next week. This is an earnings play and I'm okay taking the risk because $78 is right around its 200-day EMA and my model shows 30% upside in 1 year and 271% in 5 years. So even if I get assigned the shares, I'm happy to own it at that price. Now, let me walk you through my core long-term holdings and current swing trades. And of course, you can track all of these trades, entries, price targets, and predictions in the spreadsheet linked below. Let me know in the comments. Are you buying any of these stocks? Did you take profits this month? I'd love to hear your strategy. All right, now let's move into one of the most exciting parts of my portfolio. That's high growth stocks, which continue to be the backbone of my investing strategy. These are the companies I believe have long term runways ahead, and many have already delivered huge returns this year. Let's kick it off with one of my top performers. That's Broadcom. I hold 111 shares at an average price of $180, and I'm currently up over 58%, which is over $11,800 in gains. But here's the thing, technically, RSI is overbought on both the daily and weekly charts. So I do expect some consolidation before the next move higher. And I'm totally okay with that. I have two reasons for that. And the first one is if I sell now, I'll owe 30% in short term taxes, which is over $3,000. And the second and most important point is I believe Broadcom still has potential to 2x from here. It's a long term winner in my view. Plus, I'm generating passive income by selling covered calls, which makes this even more valuable as a long term hold. Next up is Vertiv Holdings, one of the most exciting plays in the AI infrastructure. I own 101 shares at $84.50, and I'm up over 67% on this, which is more than $5,700 in gains. As hyperscalers and big tech double down on data centers, Vertiv, with its core strength in cooling and power solutions, stands to benefit massively. My model still sees 28% upside in 1 year and 247% over 5 years, which tells me there's still room to run. Moving along, we have Lam Research, a key player in semiconductor equipment. I hold 109 shares at $74.75, and I'm up 28% on this. Now, the stock did dip a little post earnings, but long term, I'm still bullish. Short term, my model shows we have hit the 1 year price target. So if you are thinking of starting a position now, wait for a better entry. It's run up quite a bit already, but over 5 years, I still see 126% upside. So this remains a solid long term hold for me. Now let's talk about the king of AI, that's Nvidia. I own 34 shares at an average cost of $123.25, and I'm up 40% on this. At this point, Nvidia is at all-time highs, and I'm waiting for a pullback to the 50-day or 200-day EMAs before adding more. My model predicts a 28% gain in 1 year and a massive 246% upside in 5 years. I'm confident Nvidia will continue to dominate the AI and data center space, and I don't think AMD or Intel will take much share from them. So I'm holding tight on this. Speaking of AMD, I hold 20 shares at $106, and the stock is now around $171. So I'm up 60%. There's resistance at $185, and RSI is already in overbought territory. So I'm not adding here. I'll wait for a healthier setup before jumping back in. Now let's shift gears to Amazon. I own 20 shares with an average cost of $192.76. And right now it's trading at $214, a modest 11% gain. But I'm in this for a long-term goal. My model shows a 21% upside in 1 year and 164% in 5 years, driven by AWS and e-commerce tailwinds. I'm watching the $200 level closely, which lines up with the key EMA support, and I'll be adding more if we get there. Now to Google, I hold 35 shares at an average price of $163.71, and I'm up 15%. I still see 15% upside in 1 year and 100% in 5 years. And while it had some momentum issues earlier, it's starting to pick back up now. If we get a pullback near the 200-day EMA, I'll likely add more. Now let's move on to Arista Networks, which is seeing strong tailwinds in enterprise networking. I own 20 shares at $83.65, and I'm up nearly 40%. Earnings are coming up next week, and I expect the stock to cross $130. That's where I may consider taking profits. My model projects 15% upside in 1 year and 99% in 5 years, but I'll let earnings decide my next move. Let's talk about a rare loser in my portfolio, and that's Chipotle. I now own 78 shares at $52.69, and I'm currently down 19%. This has been tough, but here's why I'm still holding it. It's now below the 200-day EMA on the weekly chart, and that's only happened twice in the last 6 years. My model still sees 17% upside in 1 year and 117% in 5 years, and I believe this is a healthy correction. I'm considering averaging down here. Let me know in the comments. Should I hold, add more, or take the loss? And finally, the trade desk. I hold 32 shares at $65.47 and I'm up 31%. They report earnings next week and I think it could push above $100. We'll see. My forecast still shows 23% upside in 1 year and 182% upside in 5 years. This one's definitely staying in my long term bag. That wraps up high growth portion of my portfolio. Let me know which of these stocks are you holding? Are you taking profits or waiting for better entry points? Next up, we'll go over my dividend stocks and ETF allocations. So make sure you stay tuned. And don't forget, all these price targets and return forecasts are available in my spreadsheet linked in the description below. You can bookmark and use it as your own tracking tool. Now let's switch gears a little. While high growth stocks are exciting, the steady and predictable nature of dividends plays are equally important in my portfolio. And this year, I've been actively building my dividend stream, and the results are already starting to show. So far in 2025, I collected a total of $1,300 in dividends, and here's the monthly breakdown. In January, I did receive $26.50, February $102, March $233, April $111, May $134, June $188, and July $507. This income is still in its early stages, but as I continue to accumulate dividend paying stocks, I can already see the compounding effect kicking in. I expect this number to grow meaningfully by the end of the year or even more in 2026. Now let's walk through my current dividend holdings, starting with Realty Income, one of my favorite monthly income stocks. I own 51 shares at an average cost of $54.80 and I'm up about 3%. The dividend yield is 5.68% and my key buy zones are around $52 and $51. It's a slow and steady kind of stock, exactly what you want for passive income. Next up is Coca-Cola. I own 50 shares at an average cost of $63 and I'm up about 9% on this position. Coca-Cola has been solid, not flashy, but very reliable as a dividend player. Moving on to LTC Properties, a healthcare REIT. I own 100 shares at $34 with a dividend yield of 6.7% and my buy zones are $33 and $31 and I plan to keep building this position slowly, especially if we see any dips. Let's talk about one of the underperformers in my dividend list. That's Target. I own 16 shares at an average cost of $117 and I'm currently down over 14%. Earnings are coming up in August, and if we see the stock go above $120, I plan to exit the position and rotate that capital into SCHD, which I think is a better dividend compounder at this stage. And my prediction model shows only 5% upside in 1 year and 25% in 5 years. So it's not worth the risk in my view. Now let's shift into ETFs, starting with SCHG, a solid dividend focused ETF. I own 321 shares at an average cost of $24.88 and I'm up over 18%. Whenever SCHG dips below the 200-day EMA on the daily chart, I continue to add more. Long term, I see this becoming one of the best total return machines in my portfolio. Next up is SCHD, which is still trading below its 200-day EMA, making this a perfect time to accumulate. I currently own 212 shares at an average cost of $27.62 and I'm currently down 4.5%. But I've already set GTC orders to buy 50 shares at $26 and another 50 at $25.60. I'm in this for the long term and will continue to dollar cost average. And the next one is JEPQ, and this is a dividend beast. It pays over 10% yield and distributes monthly income, making it a great addition to my passive income plan. I own 62 shares at an average cost of $53.68 and I plan to buy more if it drops to $51.50. Now let me talk about an experiment, AMDY, the YieldMax ETF for AMD. I hold 200 shares at an average cost of $9.70 and I'm currently down 10%, which is about $200. But I've received $540 in dividends, so overall I'm still in the green. That said, I'm not a fan of this model. You're basically losing capital while earning taxable dividends, which doesn't make sense in the long term. I plan to exit this position and reallocate into more reliable dividend names that actually hold their value. Let me know your thoughts on YieldMax ETFs and drop a comment below. I'd love to hear how they have worked for you. And lastly, we have IBIT, a Bitcoin Trust ETF. I own 15 shares at an average cost of $50.61, and I'm currently up 26%. Bitcoin has been consolidating lately after hitting all time highs. My plan is to add more shares when IBIT dips, first at $60 and then again at $54 if we see deeper pullbacks. That wraps up my dividend and ETF positions. Slow and steady, but critical to long term success. Together, they provide a strong base for passive income while I continue to take strategic risks with growth stocks and swing trades. Let me know which dividend stocks or ETFs you are building in your portfolio and what strategies you are using to reinvest or allocate that income. All right, let's talk about one of the swing trades that hasn't gone as planned, and that's Bill Holdings. I'm currently down over 17%, and the stock has been moving sideways for the last 6 months, just consolidating without any real direction. I've decided to wait until the end of August. That's when they report earnings. Depending on how the numbers come out and what guidance they give, I'll make a decision at that point. Either cut the loss and move on, or continue to hold and give it a little more time. This is just part of the game. Not every trade plays out perfectly, and it's important to stay disciplined when things don't go on your way. So far, I'm genuinely happy with how the portfolio has shaped up in the first half of 2025. Strong gains, a steady growing dividend stream, and most importantly, plenty of flexibility thanks to my 50% cash position. As always, thanks for watching and being part of the mindful investing journey. If you got value from this video, make sure to like and subscribe. It really helps push the video to more viewers like you. And now I'd love to hear from you. What changes would you make to this portfolio to boost performance in the second half of this year? Drop your thoughts in the comments below. Thanks for watching, and I'll catch you in the next one.